When everyone runs in the same direction, you would better look behind. 2025. AI spending has exploded past $400 billion, outpacing even the wildest days of the dot-com era. Picture GPU factories, Wall Street tickers, and server farms glowing gold. Wall Street's brightest trust the same closed financial loop. Trillions into Nvidia chips, endless optimism, no margin for error. But what if all this money is not building the future, but bidding up a mirage? Today we trace the warning signals Warren Buffett sees, because when the smartest minds all chase the same dream, are we racing toward progress or toward the edge of a new and even bigger bubble? In the spring of 2000, a sock puppet became the face of a revolution. Pets.com, a company barely a year old, spent millions securing a Super Bowl ad slot, one of the most expensive 30 seconds in television. The commercial was pure spectacle, a talking puppet, clever jokes, a promise that the future of pet care had arrived. For a brief moment, it worked. Pets.com became a household name, its logo splashed across delivery vans and billboards, its mascot waving from the floor of NASDAQ. Investors poured in, chasing the promise of internet riches. When Pets.com went public in February 2000, the frenzy pushed its valuation skyward, even as the company lost money on every box of dog food shipped. The numbers behind the curtain told a different story. Pets.com burned through $300 million in less than 2 years. The company's ad budget for the year 2000 alone topped $20 million, with the Super Bowl spot costing a reported $1.2 million. Revenue lagged far behind costs, but in that moment, what mattered were page views, not profits. Retail investors, drawn in by the hype and the mascot's charm, snapped up shares. Less than 9 months after its IPO, Pets.com was bankrupt. The sock puppet went to auction. Warehouses emptied overnight. The company's collapse left a single clear lesson. When the story is all sizzle and no steak, even the most beloved mascot can't save you from the math. The Pets.com saga became a warning, one that echoes every time a new technology craze promises to rewrite the rules. Webvan promised a future where groceries arrived at your door, fresh from a warehouse humming with robots and conveyors into a network of automated distribution centers before a single year of meaningful revenue. Each facility cost between $30 million and $35 million to build and equip. Atlanta, Dallas, and Foster City all came online in rapid succession, their racks and chillers ready for orders that never arrived in volume. By mid-2000, Webvan's capital commitments for expansion had surpassed $400 million, with quarterly cash burn rates topping $50 million. The warehouses stood half empty, their utilization barely scraping 20% at the time of bankruptcy. Supply chain executives faced mounting pressure as new cities joined the rollout. Chicago, Los Angeles, and beyond, each requiring an outlay of $30 million. The pace was relentless, driven by a belief that scale would bring customers, but the math was unforgiving. Webvan's infrastructure spending outpaced its actual sales by 15 times. The company's gamble mirrored another phenomenon of the era. Telecom giants laying down hundreds of thousands of miles of fiber optic cable, most of it destined to remain dark for years. In both cases, capital flowed faster than demand, leaving behind empty warehouses and idle network lines. The lesson was clear. In the rush to build the future, even the most advanced systems can become costly monuments to overconfidence. Warren Buffett watched the dot-com spectacle from a quiet distance. In 1999, the financial press treated his absence from the tech party as proof he had lost his touch. Fortune ran a cover story with Buffett's face under the headline, "What's Wrong, Warren?" a pointed jab at his refusal to join the internet gold rush. While Wall Street cheered every new initial public offering, Buffett stuck to his own rules: buy businesses with real earnings, clear value, and understandable futures. He called tech stocks a speculator's game, warning that excitement alone could not justify sky-high prices. The ridicule grew louder as the NASDAQ doubled, then doubled again. Yet Buffett held his ground, unmoved by the fear of missing out. He kept his money in companies like Coca-Cola and Gillette, businesses built on steady cash flows, not page views or promises. When the dot-com bubble burst in 2000, the laughter stopped. Over the next 5 years, Berkshire Hathaway returned more than 80%, while the Nasdaq lost half its value. The same headlines that once mocked his caution now praised his discipline. For Buffett, patience was not just a strategy, it was a shield. He knew that markets reward those who wait for clarity, not those who chase every new trend. His approach was not flashy, but it was reliable. In a world spinning with hype, Buffett's restraint became a kind of moral compass, a reminder that understanding, not excitement, is the true foundation of lasting wealth. Cash poured into the AI sector at a rate that dwarfed anything seen in the dot-com era. Microsoft committed $120 billion to AI infrastructure, the largest capital expenditure in the company's history. Amazon announced $100 billion for data centers and chips, a figure that eclipsed its entire cloud build-out from the previous decade. Meta, chasing relevance and scale, earmarked $72 billion for AI-driven platforms and server farms. Google, never one to be left behind in an arms race, budgeted $85 billion for its own AI expansion. Boardrooms in Redmond, Seattle, Menlo Park, and Mountain View became war rooms, each executive team pushing for more chips, more servers, more contracts. SEC filings and quarterly reports read like shopping lists for a new industrial age, tens of billions for GPU clusters, gigawatt-scale data centers, and advanced purchase agreements that stretched years into the future. In 2025 alone, the four tech giants' combined AI capital expenditures crossed $377 billion, a number that, by itself, would rank among the top economies in the world. Each company's filings told the same story, line after line of committed outflows, hardware purchase obligations, and multi-year lease agreements. Microsoft's 2025 10K filing detailed a surge in Azure infrastructure spending, driven almost entirely by AI workloads. Amazon's disclosures showed a sharp jump in property and equipment assets, with a footnote tying the increase directly to AI server deployments. Meta's annual report cited AI infrastructure as the primary driver behind its highest ever capital spending. Google's financials broke out a new line item for AI hardware and data center expansion, a category that ballooned to $85 billion in 12 months. The numbers were so large they seemed abstract, until compared to revenue. For every dollar brought in by new AI services, more than 10 were spent building the machinery to support them. Analysts tracked the escalation with a mix of awe and anxiety. The consensus was clear. No other sector had ever seen this scale of investment in such a short window. The checkbooks were open and the race was on. Nvidia's financial statements read like a puzzle with missing pieces. In 2025, the company committed up to $100 billion to help OpenAI finance the construction of 10 gigawatts of new AI data center capacity. The catch is that every dollar flowing out the door came back as a purchase order for Nvidia's own chips, millions of graphics processing units destined for racks in facilities built with Nvidia's money. Oracle, meanwhile, took on $40 billion in chip purchases, much of it debt-financed, to supply AI compute for OpenAI and other model builders. CoreWeave, a rising graphics processing unit cloud provider partly owned by Nvidia, inked $22.4 billion in commitments from OpenAI. Even here, Nvidia did not just sell chips. It agreed to pre-purchase $6.3 billion of CoreWeave's graphics processing unit cloud services, guaranteeing revenue for its own customer and ensuring that unsold capacity would never sit idle on the books. The mechanics behind these deals are rarely spelled out in public filings. Instead, they show up as aggregate purchase obligations, performance commitments, or vague lines about customer financing arrangements. Term sheets and press releases hint at the structure: vendor financing, milestone-based warrants, and pre-purchase contracts that blur the line between supplier and customer. The effect is a closed loop. Nvidia's investments enable OpenAI to buy more hardware, which triggers fresh orders from Oracle and CoreWeave, both of which rely on revenue streams ultimately backstopped by Nvidia's own cash or purchase guarantees. Inside Nvidia's treasury, the logic is simple. By funding the customer, demand for graphics processing units is locked in. Hardware sales can be recognized as revenue even if the money originated on Nvidia's own balance sheet. Oracle and CoreWeave, in turn, book cloud service revenues as long as OpenAI's usage commitments are met, or Nvidia's pre-purchases kick in. Each party recognizes income on a different ledger, but the same capital cycles through the system sometimes twice. The risk, say accounting experts, is that revenue gets double counted. Hardware value and cloud service charges show up as independent revenue streams, even when both are part of the same underlying transaction. No public contract spells out every link in the chain. SEC filings aggregate billions in obligations, but never name the counterparties or disclose the fine print. Industry analysts and journalists track the flows through leaked term sheets and interviews, piecing together a picture of circular demand. For now, the loop holds. As long as capital keeps moving, every party books growth. But the structure depends on relentless expansion, on the assumption that each new dollar will find its way back into hardware orders and cloud contracts. It is a hall of mirrors, where the reflection of demand is sometimes mistaken for the real thing. In May 2025, the headlines blared with a single, electrifying claim. Artificial intelligence was driving half of all US GDP growth. Analysts on cable news called it a new industrial revolution. Tech columnists published charts showing exponential curves, their axes stretching toward infinity. Magazine covers featured glowing server racks, gold-tinted circuit boards, and the faces of startup founders hailed as the next Rockefellers. The market's mood was pure euphoria, a sense that the old rules no longer applied, that the future had arrived early and would only accelerate from here. Retail traders flooded into AI stocks, their social feeds alive with screenshots of overnight gains and rocket ship emojis. Discord channels and YouTube finance streams buzzed with talk of AI-powered everything, from logistics to legal advice, from drug discovery to dating apps. The narrative was simple and intoxicating. Those who hesitated would be left behind. Investment apps reported record inflows into AI-themed exchange-traded funds. Some platforms even crashed under the surge of new account signups. The most popular posts on our Wall Street bets weren't about meme stocks anymore. They were about GPU supply shortages and the next big AI initial public offering. Financial news anchors spoke in superlatives. One called Nvidia the new Standard Oil. Another declared that generative AI would add trillions to global productivity, citing a fresh report from Bloomberg. The story spread fast. AI was not just a tool, but the engine of the entire economy. Bank of America's chief economist went on air to say, AI is the single biggest driver of growth in the post-pandemic era. The phrase AI-fueled GDP trended on social media, picked up by politicians and CEOs, eager to ride the wave. The numbers sounded unstoppable. Every week, a new startup claimed a $1 billion valuation. Venture capitalists boasted of record returns. Tech giants announced quarterly earnings that beat even the most optimistic forecasts, at least on paper. Wall Street's favorite AI index doubled in 6 months, then doubled again. For many, the fear of missing out was stronger than any cautionary tale. Yet beneath the jubilation, a few voices began to question the substance behind the spectacle. Some economists pointed out that AI's contribution to GDP was, at best, an estimate, built on projections and multipliers, not on hard data. Others warned that the same dollar could be counted twice, as hardware sales and as cloud revenue, depending on which ledger you read. But in the golden light of May 2025, doubts were easy to ignore. The promise of limitless upside was everywhere, and the crowd only grew louder. For retail investors, it felt like the rules of wealth had changed overnight. For the moment, the story was all upside, and the numbers, at least for now, seemed to agree. In the accounting ledgers of 2025, the numbers tell a story too stark for headlines. Across the AI sector, $560 billion has been poured into chips, servers, and sprawling data centers, an amount that, stacked end to end, dwarfs the GDP of entire nations. But on the other side of the ledger, the revenue tied to these investments stands at just $35 billion. That is not a rounding error. It is a 16-to-1 gap, a ratio that would stop any seasoned auditor in their tracks. Microsoft, Amazon, Meta, and Google have each wagered tens of billions, racing to secure their place in the AI arms race. Their quarterly filings detail line after line of capital outflows, GPU clusters, multi-year lease obligations, hardware purchase agreements that stretch well into the next decade. The sums are staggering, but the returns so far are a fraction of the promise. For every dollar earned in new AI services, 16 have been spent building the machinery to chase that future. Nvidia's own balance sheet reflects this dynamic. Hardware orders are recognized as revenue the moment chips leave the factory, even if the underlying demand is propped up by vendor financing or pre-purchase contracts. Oracle and CoreWeave, both deep in debt, book cloud service revenue as long as OpenAI usage commitments are met, or as Nvidia pre-purchased capacity is drawn down. Yet much of this revenue is circular. Money flows from one partner to another and back again, sometimes being counted twice, sometimes 3 times, depending on which ledger you read. The opacity is not accidental. Securities and Exchange Commission filings aggregate billions in obligations but rarely specify the counterparties or the fine print. Performance commitments, purchase obligations, and customer financing arrangements are bundled into footnotes, with details redacted or withheld under claims of competitive secrecy. Forensic accountants warn that this structure can mask real risk. If end-user demand falters, the hardware sits idle, but the capital is already spent and the revenue already booked. What makes the 16-to-1 ratio so alarming is not just the scale, but the speed. In just 3 years, the AI sector has burned through more capital than the entire fiber optic overbuild of the late 1990s. Unlike dark fiber, which could be held for decades at minimal cost, idle AI racks lose value by the month, demanding ongoing power and cooling, even as their resale value plummets. Depreciation is relentless, and the margin for error is razor thin. For now, the numbers remain hidden in plain sight, buried in annual reports, footnoted in investor calls, and glossed over in press releases. But the math does not wait for narrative. $560 billion out, $35 billion in. 16-to-1. In the world of finance, such a gulf is not a warning, it is an alarm. In conference rooms from Boston to Palo Alto, researchers and investors have begun to tally the results of the AI boom. The numbers are sobering. In a 2025 survey led by MIT, 95% of companies deploying AI reported that their projects failed to deliver measurable value. That figure cuts across industries: finance, healthcare, logistics, retail, spanning ambitious startups and Fortune 500 giants. For every celebrated AI breakthrough splashed across headlines, dozens of initiatives vanish quietly, their code abandoned, budgets written off, and teams reassigned. The pattern repeats: a grand vision, a flurry of hiring, millions spent on cloud compute and consulting, then a slow realization that the promised gains will not materialize. Inside the world of venture capital, a similar story unfolds. More than 60% of all venture funding in 2025 flowed into AI startups, according to Crunchbase. This flood of capital has created a crowded field, with thousands of companies chasing the same market segments: generative text, image synthesis, enterprise automation, and vertical solutions for law, medicine, and finance. The competition is fierce, but the path to profitability remains elusive. Most AI startups burn through their seed and Series A rounds without ever finding product-market fit. Many rely on subsidized compute from cloud partners or discounted chip access brokered through industry alliances, stretching their runway but rarely changing the outcome. The MIT team interviewed chief technology officers and project leads who described a familiar cycle: initial excitement, pilot deployments, then disappointing results. One bank spent 2 years and tens of millions developing an AI credit scoring tool, only to abandon it after regulators flagged fairness concerns and error rates. A healthcare startup invested heavily in a diagnostic model that failed clinical validation, leading to layoffs and a full write-off. In both cases, the technology worked in the lab but faltered in the real world, unable to navigate the complexity and unpredictability of live environments. Venture capitalists pressed for returns now face a paradox. With more than 3/5 of all venture capital bets riding on AI, the collapse of even a handful of high-profile startups could send shockwaves through the entire tech funding ecosystem. Some partners have begun to question the wisdom of this concentration, sharing concerns in internal memos and limited partner updates. Yet the momentum continues, driven by the fear of missing out and the hope that one of these bets will become the next foundational platform. Forensic accountants and industry analysts warn that the fragility runs deeper than balance sheets. The high failure rate, combined with the clustering of capital and talent, means setbacks in AI are not isolated. They ripple outward, affecting suppliers, customers, and markets far beyond Silicon Valley. The numbers, once buried in academic papers and quarterly reports, are now impossible to ignore. 95% failure, 60% of venture capital at risk. In this environment, optimism is no longer enough. The math demands a reckoning. Patterns in financial history rarely vanish. They resurface dressed in the technology of their time. In the late 1920s, radio swept the American imagination. Companies with little more than a transmitter and a dream lined up for initial public offerings. In 1929 alone, radio initial public offerings peaked, with investors pouring millions into firms that promised to wire the nation's future. The air crackled with possibility, but profits were scarce. By the time the dust settled, most radio stocks had collapsed, wiping out fortunes and reminding a generation that not every broadcast could carry a business model. 70 years later, the cycle repeated with new hardware. Cisco systems became the backbone of the internet, its routers and switches powering the digital revolution. At the height of the dot-com boom in March 2000, Cisco's market value soared past $550 billion, making it the world's most valuable company. Analysts predicted endless bandwidth demand, and Cisco's earnings calls became rituals of optimism. But as the Nasdaq unraveled, so did the illusion of limitless growth. Within 2 years, Cisco's share price had fallen by 86%, erasing hundreds of billions in paper wealth. The company survived, but its stock would not return to its peak for more than 15 years. Market historians trace these arcs with a sense of déjà vu. They point to the same ingredients: a breakthrough technology, a rush of capital, and the belief that old rules no longer apply. In each case, infrastructure was built at a dizzying pace: radio towers, fiber optic cables, server farms, only to sit idle when demand failed to keep up. The numbers are stark. After the 1920s radio mania, a wave of bankruptcies swept through the sector. After the dot-com crash, more than 500,000 miles of fiber optic cable lay dark, waiting for a future that took decades to arrive. These episodes are not just footnotes. They serve as a kind of financial seismograph, recording the tremors that precede a market correction. The radio boom ended in a crash. Cisco's fall became a case study in overreach. Each time, the promise of a new era blinded investors to the realities of cash flow and sustainable demand. As the AI age accelerates, the echoes grow louder. The lesson, say market historians, is not that technology fails, but that markets, in their excitement, often forget the limits of growth. The past leaves its warnings in plain sight, waiting for those willing to look. September 2025 opened with a jolt. Overnight, the Federal Reserve raised its benchmark rate by 75 basis points, a move that caught even seasoned traders off guard. The announcement hit the tape at 2 p.m. on a Wednesday. Within minutes, the futures market lurched downward. AI-linked ETFs, many of them leveraged 2 or 3 times, began to unravel. Algorithms kicked in, selling billions in tech shares to cover margin requirements. The screens on Wall Street flickered red as circuit breakers tripped, pausing trading in some of the most popular AI funds. On social media, panic spread faster than the news itself. Discord servers for retail investors filled with frantic posts, screenshots of margin calls, pleas for advice, and resignation as positions were liquidated at the worst possible prices. YouTube finance personalities who had spent months touting the unstoppable rise of AI stocks went live, their faces drawn, voices shaky. Some admitted to losing half their portfolios in a single afternoon. Others tried to rally their followers, but the comment sections filled with stories of forced sales and wiped out gains. By Thursday morning, the ripple effects extended far beyond the tech giants. Margin calls hit retail brokerage accounts in waves. Investors who had borrowed to chase AI's rapid ascent found themselves selling at fire sale prices. ETF managers, required to rebalance holdings, dumped shares of Nvidia, Oracle, and CoreWeave into a market with few buyers. The volume was staggering. In just 48 hours, more than $90 billion in market capitalization evaporated from AI-heavy indices. The pressure wasn't limited to retail. Hedge funds running long leverage strategies scrambled to unwind positions, triggering a cascade of sell orders. Even institutional money managers, usually buffered by size and diversification, found themselves caught in the downdraft. Some funds suspended redemptions, citing extraordinary volatility. Others posted urgent updates to clients, warning of potential losses and temporary trading halts. Stories began circulating of small investors who had staked their savings on the AI boom. Teachers, delivery drivers, recent college graduates, now facing losses they could not afford. The optimism that had fueled months of relentless buying was replaced by a new mood: exhaustion, regret, and anger at the forces that had turned a gold rush into a rout. By the end of the week, the headlines had shifted. The AI sector, once the engine of market growth, now stood at the center of a rapid and painful correction. Margin debt balances fell to their lowest level in a year. ETF inflows reversed, with billions pulled from funds that had once promised easy riches. For many, the lesson was harsh and immediate. Leverage magnifies not just gains, but losses, and when the tide turns, it can sweep away even the most enthusiastic believers. In the hush that follows a market storm, the true cost of excess becomes impossible to ignore. Server halls once alive with the hum of AI workloads begin to power down, row by row. The gold glow that lit up 1,000 investor presentations fades to cold blue shadows. Inside these silent halls, racks of GPU cards sit idle, drawing just enough power to keep the lights on, their value slipping away with every passing week. For the giants who wagered billions, the math is no longer abstract. Cooling systems run for empty bays, maintenance teams walk aisles lined with unused machines, and the electric bill arrives whether or not the racks are earning a single cent. Unlike the dark fiber of the Dotcom era, buried and forgotten but cheap to keep, these servers demand constant attention and cash. The depreciation is relentless. In less than 5 years, what cost hundreds of millions to build can be worth pennies on the dollar. Across the country, regional power grids feel the aftershock. Utilities that spent years upgrading substations and stringing new transmission lines for promised AI demand now face stranded costs. Local governments, counting on tax revenue from booming data centers, see their projections collapse. In some towns, the only sign of the AI revolution is an empty parking lot and a locked gate. Amid the silence, Warren Buffett's words echo. The stock market is a device for transferring money from the active to the patient. For those who chased the frenzy, the lesson lands hard. Activity, buying, building, betting, felt like progress. But in the end, it is patience that keeps capital safe. Buffett's refusal to join the crowd was not stubbornness, but discipline. He knew that markets reward those who wait for real value, not those swept up in the latest mania. As the last servers power down, the difference between speculation and investment becomes clear. The patient, often mocked for sitting on the sidelines, now find themselves holding the only thing that matters: capital, preserved and ready for the next true opportunity. The chaos of the boom gives way to a quiet reckoning, where only those who remembered the lessons of history are left standing. Right now, over $500 billion are chasing AI dreams, while 95% of projects quietly fail. This isn't just history repeating, it is the present accelerating. As capital floods the same closed loops, risk pools at the system's core. The lesson isn't caution for its own sake, but for survival. In markets and in revolutions, patience outlasts euphoria. The next chapter depends not on who runs fastest, but who remains standing.